Hare Krishna. Welcome to Tax YouTube channel. This is your one Pingai, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. So today we are going to discuss on topic corporate taxation under Income Tax Act 2025. So let's dive into it. Let me allow to share my screen. Yes. So we are going to discuss corporate tax under Income Tax Act 2025. So before start the session, let's have a look on the 90-second video.
Good evening, colleagues. The transition to the Income Tax Act 2025 is new and is more than just a renumbering exercise. While the core philosophy remains stable, the 2025 Act introduces logical grouping and the new single tax year concept. For corporate taxation, the base rates of 25, 22, and 15% are preserved under new section numbers like Section 200 and 201. One major shift is MAT. The rate drops from 15 to 14%, but for those in the old regime, it now acts as a final tax. This means no fresh MAT credit generation post-April 2026. Careful planning for credit utilization is now critical. In the non-corporate sector, cooperative societies see Section 80P transition to the cleaner Section 149. The special 15% regime for new manufacturing cooperatives is now under Section 204, mirroring the corporate benefit. For NGOs, the term Registered Non-Profit Organization, or RNPO, is the new unified umbrella for trusts and societies. All scattered provisions for RNPOs are now consolidated in Chapter 17, streamlining registration and the 85% application. Registration validity for smaller RNPOs is extended to 10 years, significantly reducing the compliance burden. As we approach tax year 2026-27, dual compliance is the reality. Must prepare parallel computations for both acts. Let's embrace this change to bridge the gap between old practices and the new framework. Together, we grow stronger as a profession.
So this was the trailer and covered actually corporate tax, cooperative society, and also registered non-profit organization. But today in this session, we will going to discuss corporate taxation, and the video or the session is in a Q&A format. So you will also little bit enjoy how much you are now understand till it is now we are in a third month from the act is applicable, that is 1st April 2026. So let's start with it. Our first question: the charge of tax on total income under the Income Tax Act 2025 has been completely overhauled or remains unchanged? You need to try to answer on your own there while watching this video. Okay, so answer is remains unchanged. The basic charging provisions and classification of income under the different heads remain exactly the same as before as per the Income Tax Act 1961. There is no change in Income Tax Act 2025. Only the section numbers have changed in the new chapter 4. A domestic company continues to be taxed on its global income. This provides what much needed stability to the business. Next question: heads of income classification in the new act, completely new classification or same as before? That is new chapter 4. Yes, same as before, new chapter 4. So the 5 heads of income remains what identical, right? New act has used cleaner language, but the core principles and on judicial precedents continue to apply seamlessly. So we do not need to relearn the basic classification framework. Then residential status rules for companies have been significantly modified or remains unchanged? What do you think? Remains unchanged. Yes, an Indian company continues to be treated as a resident in India, irrespective of where its control and management is situated. Foreign companies are resident only if POEM, that is place of effective management, is in India. The POEM test remains exactly the same as before. Okay, there is no change on that ground. So this stability is particularly important for multinational groups operating in India. So new act has only used what simpler language while preserving all earlier principles and compliance requirements. Okay, means after this session we will clear your doubts what has changed or what has not changed related to corporate taxation. So moving on to the next question, global income taxation for resident companies continues only on Indian source income or on worldwide income? What do you think? Yes, on worldwide income. So taxation for resident companies always on worldwide income. So all resident companies, including Indian companies, are required to pay tax on their worldwide income. So this principle has been carried forward unchanged into the new Act 2025. So it ensures what? That income earned outside India by Indian companies remains taxable in India, subject to what? Double tax avoidance agreement relief, that is DTAA relief. Next, moving further. Next question. Poem, that is place of effective management test for determining residency of foreign companies, has been abolished or remains unchanged? Yes, remains unchanged. The poem test for determining the residency remains exactly the same as before. If key management and commercial decisions are taken in India, the company is treated as a resident. So proper maintenance of board minutes, recording of decision-making process, and documentation of location of key decisions remain critically important even under the new Act. Base tax rate for domestic companies, that is a non-concessional regime, increased to 30% or continues at 25%. What do you think? Tax rate for domestic companies. Yes, nothing has been changed on the rate ground. It is continues to be 25%. Government has maintained complete stability in a tax rates. Okay, no tinkering has been done. Next, tax rate for foreign companies reduced to 30% or continues at 40% effective. What do you think? Yes, again, there is no change, continued at 40%. Special provisions for royalty fees for technical services, that is FTC, have been renumbered, but the treatment and withholding obligations remain largely the same. Then, old section 115 BA, that is 25% existing manufacturing, now corresponds to what you think, section 200 or section 199? Anybody can answer if you have learned already on your own. Section 199, that is all original conditions attached to this regime also have been carried forward without any dilution. Companies already enjoying this benefit will continue to get it seamlessly due to the savings provisions introduced in the new Act. So now moving further, next question. Old section 115 BAA, that is 22% optional regime, is now section 199 or section 200? Very straight, because in earlier question we have already answered. Section 199 is already answered for 115 BA. Okay, so section 200 is for 115 BAA. Corresponding section is section 200 under the new Act. So this continues to be the most popular and widely opted concessional regime, right? That is 22% among the companies. So it provides what? Tax at the rate of 22% plus applicable surcharge and cess. So effective rate will be 25.117. So in exchange for what? Foregoing all the most of the deductions and exemptions. So the regime brings significant simplicity and certainty in tax planning. So there is also no MAT applicability. They are also exempt from the MAT applicability, right? Moving further, old section 115 BAB, that is 15% new manufacturing, is now section 200 or 201. Simple, already 199, 200 covered. So section 201 for 115 BAB corresponding section. So available only for whom? Genuinely new manufacturing setups after 1st October 2019. So strict conditions regarding no splitting or reconstructions apply here. All conditions, restrictions on deductions, irrevocability of the option remain exactly the same as before. So companies that have already exercised the option under the old Act will get the benefit seamlessly due to the saving provisions under the new Income Tax Act 2025. So no fresh form 10IC or 10ID is required to fill. Moving further, companies under 22% or 15% regime are still liable to MAT or fully exempted from MAT. What do you think? Yes, special regime. Those who are applying or adopting for special regime are fully exempt from MAT. So complete exemption from minimum alternate tax is one of the strongest incentives for opting into this concessional regime, that is 22% and 15%. So this benefit has been carried forward unchanged. Companies opting for these regimes get complete peace of mind from complex MAT calculations and credit tracking every year. Next, the option under concessional regime is revocable or irrevocable once exercised. Very important. What do you think? Is it revocable or irrevocable once exercised? This 22% or 15% option. What do you think? Yes, it is irrevocable once exercised. So we are need to take very much careful before suggesting this option to our client. So once a company exercises the option for either 22% or 15% regime, it becomes what? Irrevocable. This is a very important consideration while advising your clients. As I said, many companies have later faced difficulties when new projects with a heavy incentives become available. So therefore, a true long-term analysis is essential before making this choice. So as it is irrevocable, always prepare what I can suggest detailed 5 to 10 year tax projections before recommending any regime to your clients. So you need to be taken care of, and you need to take efforts on that particular part. Moving further. Next question. Set off of losses from exempt units under concessional regimes fully allowed or not allowed? Yes, of course, not allowed. Companies opting for concessional regime 22 or 15% cannot set off losses from units enjoying the exemptions against the income eligible for the lower rate. So this restrictions applies uniformly to the both 22% and 15% regimes. Proper maintenance of unit-wise or source-wise accounts becomes critical for compliance as well as for during the assessments. Next, enter corporate dividend deduction under 22% regime fully available or generally not available. What do you think? Huh? Have you heard? Have you read? Generally not available. So new act has brought clarity on the availability of the deduction for enter corporate dividends under the concessional regimes. Generally, this deduction is not available under 22% regime, though limited maybe relief exists in certain situations under 15% relief. But I think as I know, this is not available under the 15% regime also. So, but you may go through the whatever the law related to this and then take a decision. So this clarification will help reduce your dispute during assessments. Next. So before opting for any concessional regime, one must decide quickly or prepare 5 to 10 year projections. Yes, just we have discussed this. Prepare 5 to 10 year projections because these options are irrevocable. Once it is exercised, then it is not revocable. So it is highly advisable to prepare what detailed financial projections for next 5 to 10 years under different business scenarios. So factors like future capital expenditure, availability of the incentives, and expected profitability should be carefully evaluated. So this disciplined approach helps what avoid future regret by the management. Means without any consideration, they go select the special regime and then they regret, array, why we are selected this special regime. We have a benefit under the normal tax provision. So need to be properly analyze and then present to the management also. Next. So MAT rate after the Finance Act 2026 rationalization remains 15% or reduced to 14%. What do you think? Yes, reduced to 14%. MAT continues to only for the companies that are not in a concessional regime. The change is intended to encourage more companies to migrate to the simplified concessional regimes. Moving further, next, for companies continuing in old regime after 1st April 2026, very important, MAT is eligible for fresh credit or treated as a final tax. Those who have many have heard finance minister speech also make and recollect. Yes, treated as a final tax after 1st April 2026. If a company remains in the old regime, MAT paid will be the treated as what? Final tax with no generation of fresh MAT credit. This is a significant policy nudged by the government. So companies having substantial accumulated MAT credit now, as on 31st March 2026, have a strong reason to evaluate the shifting to the concessional regime in tax year 26-27 or 27-28 onwards. Okay. Moving further, accumulated MAT credit as on 31st March 2026 will lapse automatically or can be carried forward. Very important. This is can be carried forward. So domestic companies shifting to concessional regime can set off only up to what? 25% of their tax liability per year. So not 100%, but only 25% you can set off that MAT credit, and even that when you shift to the new regime. Our next question is like that. Accumulated MAT credit as on 31st March 2026 can be set off irrespective of the regime or set off only when shift to the new regime. Yes, answer is set off only when you shift to the new regime. Means you can carry forward the credit as on 31st March 2026. Okay, that is also 15 years, but you can set off only when you shift to the new regime of taxation, and that is two with a cap of 25% of the tax liability. Means 25% for the year you can adjust. So we need to analyze as a advisor, consultant, whether company in which year has to shift from the old to the new regime so that the accumulated MAT credit 2026 should not be lapsed and should be utilized by the our client company. Next, foreign companies get MAT credit set off. What do you think? 25% cap or full set off without cap? Yes, full set off without cap. For foreign companies, the provision is different for MAT credit. They can set off fully their MAT credit. So while domestic companies face a 25% cap on utilization of accumulated MAT credit per year, foreign companies continue to enjoy the earlier liberal rules. They can set off the full eligible credit without any percentage restriction. So this differential treatment is important while advising multinational groups. So these changes in utilization of accumulated credit makes what regime selection and timing extremely critical in the coming months. So companies with a large accumulated MAT credit should seriously evaluate what they're shifting. Okay. Very, very much important. This is the very much important part in the session, right? So book profit next is yes, book profit for MAT is computed starting with taxable income, net profit as per Companies Act or Ind AS. What do you think? Book profit for MAT is computed starting with taxable income or net profit as per Companies Act or Ind AS. What do you think? Yes, net profit as per Companies Act. Ind AS, it will what? Book profit for MAT. Okay, we will start with that. So step by step calculation of MAT remains almost the same as before. Nothing has been changed from the old act to the new act shifting, right? So which is good for continuity. So many adjustments have been moved to the schedules for better clarity and reduced litigation. Then return filing provisions are unified under section 139 or section 263. What do you think? Section 139 is a old Income Tax Act 1961 for return filing. Now it is a section 263 under the Income Tax Act 2025. So this is one of the area where the new act has brought very good simplification. So under the old act, return related provisions were scattered across what many subsections of section 139. So making it what cumbersome to refer. So in the new act, all types of returns, original, related, revised, updated, are now under covered in a one section. So this change will reduce what confusion, minimize compliance errors, and make the law much easier to navigate for both taxpayers and professionals. So next, the due date for audited corporate returns changed to 30th September or remains 31st October? Yes, of course, it is remains 31st October. So fortunately, the due dates for filing the corporate returns have not been changed at all. Due dates are completely unchanged. Only the section reference is new. In AY 26-27, assessment year 26-27, companies will file new forms under 2025 Act or old ITR 6 under 1961 Act. What do you think? Of course, old ITR 6 under 1961 Act. So ITR 6 will continue to be the main written form for companies except the charitable companies. Only minor changes made. That is the in a current ITR 6 which we are using for relevant AY 26-27. That is removal of schedule BBS due to buyback taxation. So no reference to new Income Tax Act 2025 or new section numbers currently. Moving further, TDS TCS provisions, that is old 192 to 194T, are now still scattered or consolidated into one section 392 to 394. What do you think? Yes, these are consolidated into sections 392 to 394. So one of the most practical improvements in the new Act 2025 is the complete consolidation of all TDS and TCS provisions into sections 392 to 394. So these provisions are now presented in a clean tabular format with the rates and thresholds clearly mentioned. So rates and thresholds largely unchanged. Tax audit report under the new act remains 3CA, 3CB, 3CD or consolidated into single form 2026. Very important. Yes, it is consolidated into single form 2026. How many of you have gone through this new tax audit report form 26? I know we are in the same boat. We are still not have started reading or going through the changes in the forms, but we need to go through the form 2026. There are few but a major changes in the form 26. That is a tax audit report. Like we need to report the IP address where the accounts are maintained. Then we need to also comment on the how the means you need to comment how you have taken your audit particular procedure, means test check, management representation letter or detail that there are or other. So these are the drop downs we need to select. Then how the data is updated on daily basis or not, that need to also we need to comment on that. So there are many few but main important changes. So please go through the form 26, that is a tax audit report. Don't keep it or postpone till the next year. We will see whenever we need to comply for the tax year 26, 27. No, please go through and start reading it and understanding it. So this is a welcome simplification. The earlier requirement of filing multiple tax audit report forms has been done away with, and now all tax audit reporting is now consolidated into a single unified form, that is 26. So most of the deductions and exemptions that were available for companies under the old act have been what, carry forward or not carry forward? What do you think? Yes, of course, carry forward. So many of them have been moved to schedules for better readability and easier reference, change in the section numbers, but distinction between profit linked and investment linked incentives continues along with their respective sunset clauses. So there is no much changes in the deductions and exemption front also. Next, set off and carried forward rules largely changed or unchanged? Yes, unchanged. The rules relating the set off and carry forward of losses remain largely the same. So, however, companies operating under 22% or 15% concessional regimes continue to face what? Same restrictions on set off of certain losses from their exempt units. So, moving further, advanced tax liability calculation principles changed or unchanged? What do you think? Of course, unchanged. There is also no change on this ground, that is advanced tax liability. Same dates, 15 June, 15 September, 15 December, and 15 March. Rates are also same. Interest rate for late payment or short payment is also the same, remains the same. So, what are the key takeaways for practice? So, immediately update all your templates, checklist, and software with new sections. Advise your corporate clients on MAT regime switch planning at the earliest. Very important. That is accumulated credit on 31st March 2026, how it can be utilized. So prepare for dual year compliance in 2026. That is changes in TDS forms, TDS sections, then 15 CACB forms change to form number 145, 156, like that. Then the create client communication on what changes and what doesn't, so that it value add service to your client from your end. So that's it from this session. Thank you so much for patient hearing. Hope you are gaining valuable knowledge from all these video updates and video series we are conducting on a tax YouTube channel. So if you have any questions, observations, suggestions, then do let me know via WhatsApp, email, or you can also comment below the video. So stay tuned to the Tax YouTube channel. If you are not yet subscribed, then please subscribe to Tax YouTube channel. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.